Hey there, if you're a long-term investor, you've probably seen a new name pop up on your radar, the Old Bridge Flexi Cap Fund. So, what's the deal with this new offer? Well, we're going to break down all the official details so you can really understand what it is, how it's designed to work, and who it might be a good fit for.
Here's a quick roadmap of what we're going to cover. First, we'll look at the all-important dates for the new fund offer, or NFO. Then we'll get into what a Flexi Cap fund actually is. After that, we'll dive into the specific investment strategy Old Bridge is using, talk about the risk involved, and then wrap up with the practical side of how to invest.
All right, first things first, the NFO window. You can think of a new fund offer as the grand opening for a mutual fund. It's a really limited time to get in right at the start, which is exactly why you need to pay close attention to these dates.
So here are the key dates to circle on your calendar. The offer opens up on February 13th, 2026. Now, you've got a 10-day window to subscribe because it closes on February 23rd. After that, it takes a short break and then reopens for continuous buying and selling on March 4th.
So what on earth are we even talking about when we say Flexi Cap? You hear the term a lot, so let's break down what this category is all about.
The magic word here is flexibility. See, a lot of funds have pretty strict rules. They can only invest in large companies or maybe only small ones. A FlexiCap fund, on the other hand, gives the fund manager the freedom to hunt for opportunities anywhere in the market. It doesn't matter if it's a blue-chip giant or a tiny disruptive startup. They can go where they think the best value is.
Now, all that freedom does come with one really important rule. The fund absolutely must keep at least 65% of its money in stocks. But that other 35%? That's the interesting part. It can be moved into safer things like debt. This gives the manager a strategic lever they can pull to try and reduce risk if the markets start getting a little choppy. Okay, this brings us to what really makes this fund different from any other FlexiCap fund out there. It's not just about the rules of the category, but the specific philosophy they use to pick stocks, what they're calling the Old Bridge approach. They use what's known as a bottom-up approach. So instead of trying to guess where the whole economy is headed, they act like detectives, investigating one company at a time. First, they look for quality. Is this a solid business with good management? Then they check its staying power. Is this a company that's built to last? And finally, the most crucial step, they look for a bargain, aiming to buy that great company for less than they think it's truly worth. And this quote really sums up their entire philosophy. This isn't about trying to time the market or chase the latest hot trend. It's about finding what they believe are great businesses and owning them for the long haul, almost like they're a partner in the company itself.
Of course, anytime we talk about investing, especially in stocks, we have to talk about risk. So let's be really clear about how this fund is officially categorized.
So let's just ask the question straight up. If you invest in this fund, what is the actual level of risk you're taking on?
The official rating is very high risk. Now, I know that sounds pretty intense, but it's actually the standard classification for any fund that invests mostly in stocks. What it really signals is that you should expect the value of your investment to go up and down. It's going to be volatile. This kind of fund is really designed for someone with a long-term perspective, someone who can handle those market swings without panicking.
So how do we know if the fund is doing a good job? Well, its performance is measured against a benchmark, the BSE 500 index. This index basically tracks the top 500 companies in India. The goal for the fund manager is simple, but not easy. Over the long term, they aim to deliver better returns than this broad market index. That's the bar they've set for themselves.
All right, let's move on to the practical stuff. If you're thinking this might be a fit for you, here are the key numbers you need to know to get started.
Let's just break down the key numbers you'll need.
If you want to make a one-time lump sum investment, the minimum amount to get in the door is 5,000 rupees. Or if you prefer to invest a smaller amount on a regular basis, you can set up a systematic investment plan, or SIP. The minimum for that is just 1,000 rupees a month.
Now, let's talk about something really important that's designed to encourage long-term thinking. It's called an exit load. Basically, it's a small fee you might have to pay if you decide to pull your money out too early.
Here's how it works, and it's pretty simple. If you take your money out anytime within the first year, there's a 1% fee on the amount you withdraw. But if you stay invested for more than 365 days, that fee drops to zero. It's just a little nudge to remind you that this is meant to be a long-term investment.
So let's do a super quick recap. The NFO window is a short one, February 13th to the 23rd. It's a FlexiCap fund, giving it the freedom to invest anywhere. The philosophy is bottom-up, focusing on quality businesses. It's classified as very high risk, so it's for long-term investors. You can start with 5,000 rupees lump sum or 1,000 via SIP. And finally, remember that 1% exit load if you sell within the first year.
And all of this brings us to the most important question, the one you really have to ask yourself. Does a strategy that focuses on owning great businesses for the long haul, without getting caught up in predicting the market's every move, truly align with your own personal investment goals?